we're going to talk about balances, areas of balance versus areas of imbalance today, because that's what's going to help beginners as well as all of the intermediate traders who are getting lost in the sauce, right? So we have to understand this from a more macro perspective, and there are people who understand what I'm about to teach from a macro perspective innately, right? But I'm gonna articulate it today, and I'm gonna break it down in hopefully such a way to where like you understand what's going on. I do already have a balance versus imbalance video that I would recommend that everyone watch. Um, where it is right here. Let me see. Balance versus imbalance. So here's the link and the video. Like that's I'm gonna be going over what I went over in this video, but it's gonna be from a more refined place because I made that video a month ago. Okay. So I'm gonna make a new version of that video right now on this live stream with everyone, and then it shouldn't take as long to recap everything that's in that video, and then I will start to bridge the gap um, from that and where we left off last week, which was ICC and where this comes into play. And then maybe next week we'll actually dive into wick sauce. But this is like a must know for everyone. Um, so once you understand this on a very basic level conceptually, then order blocks aren't going to scare you. Gaps are not going to scare you. You're going to know exactly what they are and why they're even there to begin with and what they represent and how the market interacts with them at those areas. So that's what this is going to be about. This video was inspired by a couple of things that I learned, but I had saw an Instagram post. Actually, yeah, let's play it. Let's, let me go find it. I think I sent it somewhere. But it was inspired by Instagram posts of this guy just saying some things that I really did agree with already. So I'm just gonna send the link to the chat and you can watch it if you would like. Maybe with the Discord call in the background or something like that. All right, I'm back. Are you able to hear me still? So yeah, I sent it to the chat. Cool. Um, and in that video, he was just basically saying that like ICT concepts and all of the vocabulary, all of that lingo is not, shouldn't be that scary. It's just like basic price action repackaged into a bunch of complicated vocabulary words. So what I'm doing by teaching this from this perspective about balances and areas of balance and imbalance, I'm not saying that my interpretation of this is like the final end all be all interpretation of this, but it is a simplified, it is the most complex simplified interpretation that I can have. It's balanced. So without too much more edging going on, I'm gonna go ahead and just start talking about it, okay? And I have the chat up here. So I see all you guys right here, and I'm gonna look over here. I'm gonna start drawing. So if you have questions, let me know. Someone said no audio. Are you guys able to hear me? All right, cool. And my recording is picking up my voice. All right, cool. So there are two areas in the market. Okay. Um, you have areas of balance, and then you have areas of imbalance. These are like this is all there is. Okay. The market is very dual natured. It's buy and sell. It's up and down. It's high and low. It's open and close. It's balance and imbalance. If we know what a gap in the market is, then what is the opposite of a gap? Order blocks, in a way. And the thing is that all of this happens on small scales, and when I say small scales, I also mean on fast scales. So this happens on both fast scales and on big scales. So I'll just kind of make that note right here. This happens on all scales, aka large and small. Um, Slow and fast, aka high time frame and low time frame. Okay. So we're constantly making areas of balance and imbalance. So now really quickly, like what are some characteristics of balance? What are some characteristics of imbalance? Characteristics of balance include things such as like we have both buyers and sellers. And I'm just gonna say like it's, I'm just gonna say we have both buyers, yeah, and so I like to write in shorthand, so I'm not gonna lie. So in my shorthand is we have both buyers and sellers. Um, Whereas here we only, wrong color, we only have buyers or sellers, right? What's another characteristic? So this is really it. This is the definition of it. Okay. This is as simple as it gets. The definition of balance, both buyers and sellers are present in that area. So that's the other thing I'll probably notate, right? That this and this are price ranges, aka or like price ranges slash areas. Okay. We're not talking about price lines. We're not talking about price levels. We're talking about ranges of price and ranges of, yeah, like ranges of price action. Okay. Um, so over here on this side, we're gonna hear words such as like gap, gap, or FVG, fair value gap, or whatever the case is. And then over on this side, we're going to be hearing words such as order block, and words such as like consolidation. And this is going to lead us into wick sauce next week for sure, because this is where I start to spark controversy. Wick. Um, whoa, my bad. Hold on, I got that totally backwards. Hold on, I got that totally backwards. Thank you, thank you. All right, over here, this is where we have areas, words such as order blocks. Um, and what else did I say? Consolidation, and wicks. And then over here, we have things such as on areas of imbalance, we have gaps, FVGs, etc. Okay. Which side is a change of structure? We're not even, oh, I mean, we're not talking about that, but that's going to be, so change of structures are going to be, so I'll put it like this. All right, cool. Where these two meet, this is where you get break of structure. That's where you get change of character. This is where you get indications. This is where you get basically price action in a way. Like you get market structure. Okay? It's the merging of these together. That's what we're actually analyzing all the time. But people don't know, like, okay, what happened in this area that led to an imbalance being created, and what happened in this area of imbalance that led to a future area of balance. Like all of the analysis that we've been doing about market structure and the areas we mark out, those are just the areas where these two meet, kind of like where the ocean meets the sand. Okay, you'll where the ocean meets the sand, that shoreline, think of that as your price line. That's where you're always doing your analysis, um, and different things like that. Like that's where you're executing trades, most of the time. That's where all of that is going on. What we're going to be focused on is how do we analyze 99% of the chart, the rest of the chart, which consists of all of this and all of this. This is going to be, I'm speaking hypothetically here, don't, you know what I'm saying? But let's just say like this is going to be about, this is going to account for about 60 to almost 70% of the chart. Yeah, no, I mean this is going to account for like 70% of what you see on the chart. This is going to account for about 25% of what you see on the chart. And then this right here is just about 5% from my perspective. So all of the analysis that you've been doing has only been scratching the surface in a way, right? Sometimes this ratio might switch, but like it's gonna be something like this. I made it extreme on purpose. This might be like 60%, this might be 30%, this might be 10%. But so we're gonna spend a lot of time analyzing what goes on here and what goes on here. So that way we know, like this is gonna tell us we need to know what is going on here, so then we know why are we taking a buy, why buy or sell. That's what I'm getting at. So anyway, let's go ahead and start talking about it. um what colors did I use? Blue, pink. All right. mm, Type in the chat if you've watched the balance versus imbalance video already. All right. mm, all right. All right, bet. I'm gonna just leave it right here for a second, I think, because I know what I want to explain. Let me see. All right. I apologize. I know this is tedious, but you already know it's going to be valuable. Okay. Um, on my videos, I was talking about an MBM. Forgot the name. I don't know. BTM. Oh, beat the market maker. Beat the market maker, or market maker model, or MMM. It's something that I used to study. MMM or BTMM. If you Google it. Yeah. 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 There's a lot of stuff that to cover. But anyway. So what I have drawn here is like a very um overall like schematic, like a very basic schematic of just a way that the market might move, right? What we're trying to analyze here is um not anything technical, not liquidity, not anything like that. We're still on a very lofty conceptual level. So up here is an area of balance, right? Everything that's blue is an area of balance. So we got it like that's an area of balance. This is an area of balance, 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 balance here, and balance here. So then everything else, theoretically, don't get confused. This is not necessarily an indication per se. When I write this, this is just showcasing that this is an I. Here, I'll write it down here, like for imbalance. Okay. All right. So what we have to understand is, first of all, is that what does ICC do? What is the objective of ICC? The objective of ICC is to get into a trade that allows you to capture the leg or a price leg. Like, so what is a price leg? This is a price leg. This is a price leg. Like a leg of market structure or an impulse or something. So ICC is trying to get you into these trades right here. AKA, like, if you trade ICC, ICC leads you to make money at the creation of imbalances in the market. This is just that extra, level of information and sauce that just normally not going to get, right? Imbalance. So how does that, what does that look like? For example, we have a high, we have a high right here, a low right here, a lower high, price breaks that low, closes here, and then now this is the continuation of this price leg to the downside. Okay. And so what are we trading? Oh, well, Romel, we're counter trend trading because we broke this high, right? But we're trading a confirmed trend right here. So are we counter trend trading or are we trend trading? Once you start asking yourselves these type of questions, that's when you get to the level that I'm at where it's like, oh, well, yeah, we are trend trading in relation to this trend, but we're counter trend trading in relation to this trend. But then what if I said, bet this is my I, all of this is my correction phase, and then this is my continuation phase? Well, guess what? I'm trading a trend, a confirmed trend that is what? A correction of another trend or another impulse. We sold all the way down to here. So this trend that I'm trading is still in the correction phase of a bigger trend in the past. I just said a lot. For those who know, you know, but I just said a lot right there. So let's just back up. Okay. So the point is you have to understand, not understand, you have to identify the range that you're playing. You have to look at the cards that you have in your hand. You have to figure out what you've been dealt and play it accordingly. So you know when to get out. You know when to get in. You know what's going to happen before the trade that you're actually looking for shows itself. And understanding balance and imbalance helps that. So what we're looking at here is, in so many words, we're looking at people make choices. And what kind of choices are they making? They're making psychological choices. Okay. There's so many different ways I can approach this. Just give me a quick moment, real quick, to think about how I want to do this because there's so many different tangents that I can go on. I just need to figure out like pick a path to teach it and just teach it from that perspective. Um, okay, I got it. I'm gonna teach it the way that it was taught to me. So the first time. So because the market is always in an area of balance and imbalance, what we have to understand is that one truth to the market is that, and this is truth number one, the market is always trying to rebalance itself. Okay? The market's always trying to rebalance itself. So we have to dive into understanding what does it mean for the market to rebalance itself. And that's what I was about to get into. So, for example, when the market made this impulse right here above these highs, right? And then we confirmed a downtrend. Is that why when gaps are created, they're later filled? Yes. Yes. So anyway, when we created this gap or this imbalance right here, right? So let me go ahead and draw it. Where's the imbalance? You really draw the imbalances out in market structure like this. They exist from one one area of market structure. So this is going to be a high that you mark out on this time frame. All the way down here, it doesn't matter the time frame. There's going to be a high that you mark, and then you're going to go up to the next area and you're going to mark out the lows up there. Okay. And then so really the area of imbalance truly then becomes everything under this low and everything above this high. And this is what I would call, in a way, my true like imbalance or whatever. Okay. I do not mark out fair value gaps the traditional way. So now what would this look like? This would have normally a bunch of bullish candles in it. Whoa, that's crazy. This would have like a bunch of bullish candles in it, and it might even have one big candle or whatever, right? And whatnot. So I'm not sitting here trying to mark out my imbalance like this, you know, like marking it out from the low of this candle and the high of this candle and saying, oh, this is my fair value gap. That's not what I'm doing. What I'm doing is I'm just saying, hey, I have a bunch of bullish candles here. Or even if I had red candles, even if I had a couple red ones in here, it doesn't matter. As long as my market structure, aka my highs and my lows, are um, as long as my highs and my lows are bullish still, then I'm still good. Okay, that's fine with me. Um, I'm gonna just understand that this whole range That's how I mark it out. I don't know how to explain it. We're gonna go to a chart. Actually, let's just go to a chart right now. Here's an example. Trading view. So I don't know, gold maybe. Let me find one. So right, I'm I'm on a 1 hour chart, and I am not marking out my gaps like this. Oh, here's a fair value gap here, and here's another one. I'm not doing that. This is not what I'm doing. This is so redundant. Okay. Instead, what I'm doing is I'm understanding that, okay, and this whole area is an area of balance. So this right here is equivalent to my blue. That's an area of balance. It's a place where there are both buyers and sellers. Are there both buyers and sellers inside this price range? Yeah, there's both bullish and bearish candles inside this area from this high up here down to this low here. This range, this area is just a bunch of buyers and sellers. So now how do you identify the area of imbalance? You go find the next area of balance. It's that simple. So where's the next area of balance? Well, I'm looking for red candles. Oh, here's a red candle, so I'll start it up there, and we go down to here because that's the lowest area before we broke and whatnot. So now I have my two areas of balance, like my two blue areas. So now everything under and everything above, that's my area of imbalance now. So that's why I draw from market structure to market structure. All right. And we'll make it what, pink or something feminine? I don't know. We can just make it red. That's fine too. It doesn't matter. Um, but none of these are showing like I would want it to. It's fine. Okay. So already, you know I'm on to something. Okay. I'm not teaching this for no reason. You already see what happened. You already see where the bottom of the market was. I'm trying to work my way up to teach you how to identify it, but to also show you why it happened. Like, I'm trying to get you to understand why, so that way I'm not like sighing, I'm just telling you what to do and you don't know why you're doing it. So, back to this. There's a method to the madness, okay? So just stick with me for a second. We're talking about this concept of rebalance right here. What does it mean for the market to rebalance itself? And in order to understand what it means for the market to rebalance itself, we need to understand human behavior. Okay? What do we call this? We call this the market, right? We call this whole big thing of like this whole chart. We call all this right here the market, right? Say if this is a chart. All right, well then what else do we call the market? We also call the market like Okay? Supermarket. So what's the difference between this market and this market? One has food, one doesn't. Okay, I don't know. Like, what's the difference? We call both of these the market for a reason. Okay. So what I want to get you to understand is like human behavior. Human behavior is constant and it doesn't change. At least this is what we need to believe because this is an economic principle. And an economic principle is that we will assume that people are always in the pursuit of more and that they always make logical decisions. Okay, so under this realm of human behavior, we need to assume that people want more all the time and that that is a logical decision. Okay. Um, so anyway, so the thing that these two have in common, someone said like they both consist of buyers and sellers, right? That's true. You have corporations selling, and then you have people buying. Just like how you have over here, let's just think of this as if this was a stock market. You have stocks, which are corporations, selling shares. Down here, they're selling, I mean, just goods, right? This word goods is just, goods. So what good are they selling in the stock market? They're selling shares. Shares and goods are the same. Here it could be diapers, apples, toilet paper, cars, doesn't matter. They're selling goods. So in this specific market, right? Not a supermarket, but in this specific market, they're selling stocks, right? So now we have people who are buying stocks or shares. This is doesn't matter what it is now. If we're in the forex market, futures, commodities, right? Oil, gold, silver, commodities, crypto, okay? It literally doesn't matter. How do you spell crypto? It doesn't matter. These are all just markets. So what's the golden word we're looking at? Market, right? And in order to understand all of this, we need to understand that human behavior is constant and it doesn't change. And we need to assume that people always are in a pursuit of more or better. So with this, when you go into a store, when you go into a store and they're having like a sale, right? There's a store and there's stuff on sale. And let's just say it's 50% off. What does this motivate you to do? Bet. This motivates you to hit buy. Perfect. Now, If you go into a store, and I know this is redundant, right? You already know what the answer is, but let's just say they claim to have a sale. They claim to have a sale, but their sale is, it's only 20% off. Are you motivated to buy? Yes or no? Not as much, right? Some people, some people might, some people might not. So now we're starting to get somewhere, right? So look, I'm gonna move the Discord over, okay? This is economics in action. Economics is the study of why people make the choices they make. That was my major in college. We see it right here in the group chat. So check this out. Eagle said he's not gonna buy if it's only 20% off because that's not cheap enough for him for whatever the reason is. Eddie was like, I'll pass. But Vader was uh, yeah, I'm not motivated to buy, I'll pass. Or no. He said less so. So he's like, so no, I'm not really, as motivated to buy, but I still would. You know, Andrew down here, he's like, yeah, I'll buy, but not as much. You see how there's varying degrees of it. There's some people willing to buy, some people not willing to buy, some people willing to buy a lot, some people willing to buy maybe only a little bit. Already you start to see it, right? Blue's like, I ain't buying shit. Okay, so there's various degrees of it. Now let's go to a chart. Give me a second. I'm about to. Oh my gosh, I'm about to prove a hell of a point right now. Give me a second. Um, okay, I just want to make this I don't care. It needs to be point one. I need another one to be point two. And I don't use fib extensions that much, but let me see. We'll do this. This needs to be point three, point four, and actually, well, I'll make this 1.5, point four. Give me 1 second. Just be patient with me because I'm just gonna drive the whole point home. This is a hell of a point. 90. All right. So now let's make all of these similar in color. All right. But actually, so now let me think about this. This is so now everything under I'm gonna just make this like a light color. Okay, you know what? No, it doesn't matter. That's just tedious. Gonna take way too long. This needs to be just gray. OCD is kicking in very bad right now. All right, cool. Everything should be cool. All right. So let's just say if I did this and I put price ranges, or not price ranges, but let me pull up the Discord again. Move this over here so I can see when people get their aha moment. All right. What do I have here? What I have here is I have various degrees of discount or percentages, right? So let's just go ahead and like, no, I wanted to have my 50% red for a reason. So let's just say like, all right, bet. Who is willing to buy at 10% off? All right, well, you got people who clearly live in a different world because they got a lot of money to just go ahead and buy something that's only 10% off. It's not cheap enough for me. I don't know about you. It's not really cheap enough for me. But somebody bought at 10 and 20% off. Then you got people who are willing to buy somewhere around 30 to like 20 to 30% off. And that's a pretty decent little sale. You see that every day. That's a everyday type of occurrence. You 20% off, 30% off. Oh, if you're a member of the grocery store, human behavior, right? That's decent. But how many people do you know buy something that's half off? Everybody and their mama. You mean to tell me I can get this for half the price? Psychologically, it's like it's the greatest sale in history. Whoever came up with the idea or said, I'm about to sell this for half the price, buy one, get one free, like two for the price of one, like that's like that person's, you know what I'm saying? But we can clearly see that not only do people do that in the grocery store, people do that in the department store, people do that during Christmas time, every holiday season, they do it also on the chart. Because the same people who are participating in the market in this uh trading market, whatever, they're the same niggas at the store. Okay? Human behavior. So, what I was gonna start getting at here, he's like, I do be, I do be at the store. Yeah. So, what I was gonna start getting at here was I was gonna start putting a whole bunch of different percentages here, right? And we can still do the exercise if we want to, right? Um, how many of you guys would start buying something at like, okay, let's see how many people would buy something at 10% off. Bet nobody in here should say anything. Everybody should be like, hell nah, it's not good enough, right? Like what? Like what does that really do for my pocket? Now, if I'm spending a lot of money, see, that's the whole thing. Like that's how I know what I'm saying is true. Like I said, the people who are buying up here, they must have a lot of money. So who do you think entered into the market right here? Do you think it was retail traders or institutions? Institutions. They're already telling you where, whoa, I'm not even gonna lie, I'm like coming up with a whole new strategy in my head right now. I never, hold on, this is live. Point is like everybody already knows that buying something at 10% off is not a deal. Okay. But you already know the type of pockets that they have to have if they're doing so. Okay. Exactly. This is why Sai can hold a trade because of his account size. It gives you hella fucking room. Exactly. It gives you hella wiggle room. That's what the comment section's saying, right? So when you understand what kind of people are purchasing here, you already know where price is going to buy from, keyword if it does. Okay? Watch this. Just drag that over to the right, and where does it buy from before it takes off? Where the first wave of big money spenders entered into the market. Where was the fair value gap that was created that was instantly taken off? Or like rather where was the engulfing candle? Engulfing candle right there. So like they're already telling you, like it's like a weird sort of Morse code in the market that tells you exactly where stuff is going to happen. But since banks and institutions have wiggle room, they will, and I see it all the time, they get into trades knowing damn well that the market is going to continue falling, but guess who can't handle it? You, me, retail traders. We can't handle and we can't stomach this. Okay? Then they have the audacity to induce sellers to go bearish by making it look like market structure is bearish. Watch this. We go up, make high, higher low, higher high, higher low, lower high. Then they have the audacity to make it look like price is gonna sell when it literally is just coming back for a pit stop to buy. Which is why, like, understanding order flow and all of these other higher level things are so important. Balance and imbalance, it's important to understand these things so we know that we're not getting faked out by this stuff, right? Because now we have a whole like, oh, price is going to sell back off, we didn't fill this gap, we didn't hit support. You don't think they know how you think? They already know how you think. You're trading right into them. Like, you're trading right into their hands. They're literally like sitting back there smoking the fattest cigar, just kikiing and ha-haing like, look at all these dumb people. Okay? Because that's what they call you. They call you dumb money. They're the smart money. We're the dumb money. All right? So bringing this back to balance versus imbalance. We see the area of balance here. That's all they came back to retest, was the low of the area of balance or the top of the imbalance. You see the rejection. You should, once you know this and you know what you're looking at, you should be like, damn, that's sexy, and I'm gonna get into this buy. Okay? Without being someone who's like, oh my gosh, the market has to come down. It totally just has to fill this gap. And as a matter of fact, it's going to keep crashing down because it has to fill this gap too. Nope. Trade what you see in the moment and trade the price action or the flow of orders that you see. Based on what? The range that you are playing. Because this is all based on what? The fact that I'm identifying this big range. So when you go back and you rewatch my other videos and I'm like, the market is all about ranges. Like, this is the range that we're identifying. All of this trading and price action is literally because I know how to identify this low and this high and take trades based off this range. I didn't mark out anything else. I marked out the range, the whole entire thing, which is equivalent to me marking out, say, like from here all the way to here. Then I separated it. I said, bet, here's my area of imbalance here, and my area of balance up here and balance down here. Bet, there's my balance up there and my balance down here. Then everything in between, that's my imbalance. And I can get away with 50% a lot of the time. Okay? So anyway, I'm not gonna lie, I feel like I gotta backtest this idea because I just had the idea. I knew it, it's in the back of my mind, but when I teach it, I always come up with an approach, and that's why I'm like, it's hard for me to make a course because it'll just keep progressing and leveling up over and over and over. That's why I just stick to the YouTube, for real. Just watch the YouTube videos. They get better over time. Anyway, point is, market behavior is human behavior, and human behavior would suggest that very often 50% is the level to beat. That's the level. That's where buyers should start to enter. Not the big buyers, but the buyers that are going to bottom out the market and start the buy program. 50% is the mark to beat. So in other words, I can delete this, and we can even break up this area of imbalance now, where we understand that, for example, in this area, sellers exist here, right? Or let's just put it like this. Sellers exist above 50%, and then buyers exist below 50%. Okay? So now this is why I drew this way. The sellers got in the market over here. It so so imagine like we're going up and you have people getting into the market or whatever they're doing, but we don't really start selling until we get up here. Just like how we don't really start buying for real until we get down here. Okay? That's what I was trying to articulate when I drew this. I knew what I wanted to teach in my head. I didn't know how I was going to get there. So word. So that's where sellers enter, because this is sell territory. Okay. I have no clue how to spell territory. So I'm just going to say this is my sell area or my sell zone. Okay. And then down here, this is my buy zone. And what do I want to do? I want to sell. This is how easy, because the way we're analyzing our price action is so precise. When we now this is hold on, I'm getting overwhelmed. Because the way we're analyzing price action is so precise, when we are in areas of imbalance, and I have to stress this point because this was messing up my trading a couple weeks ago. Only in areas of imbalance do you execute trades at 50%. Okay. Or what I say, like, is it safe to execute at 50%? Okay. Um, is my stream lagging? Okay. I might have to move my router into the living room, but we'll see. My recording should be fine though. So anyway, Um, so let's just go back to the chart. We're just still flip-flopping. So this is an area of imbalance. We can break this up even more. That's what I was trying to say. So to the point where we understand that between this high and that 50% mark, that is an area where sellers, no, sorry. Well, yeah, I mean, this is where sellers want to get out and where buyers want to get in. So, but this color has to be green, right? And then up here, this is where sellers want to get out of the market and buyers want to get in. No, whoa. This is where sellers want to get into the market. My bad. But does this part really matter? A little bit, not so much. Because what? We understand what? This is a bullish range. So we're not really trying to see where sellers are in the market in this area. All we're really concerned about mentally is now 50% or lower. So when you see me sending screenshots of trades and I have an entry that's on a wick, maybe now you start to understand how I get there. And but also not only how I get there, but how simple it is to get there. It's not hard. It's just you just didn't apply things that you already knew because you're a human being. You're using regular candles. Would Hakanashi candles change the way it looks? Hakanashi candles, what Hakanashi candles do, right? Because I'm a specific type of person, or I mean I'm a very detail oriented person. All it does is it offsets the open price of each candle to 50% of the previous candle. That's it. So if I switch this to a Hakanashi chart, exactly what I just said happened. Like this candle closed somewhere up here, but it offsets the prior candle to 50%, and that feedback loop keeps happening. Now, is it going to change the way your chart looks? It's just going to change like the way the bodies of the candles look. I would not trade wick sauce with Hakanashi candles on because it's also going to change the size and the range of the wick. But if you are trading like market structure, I don't think Hakanashi candles are bad. I like Hakanashi candles. It does a good job taking out noise. And if you already know how to mark out your your chart well, then why not do this? So let's just say we had this marked out and we were down on a 5-minute chart. Keep in mind, we are not doing any analysis on a 5-minute chart usually unless it's the range that you're playing, right? We could do this analysis on a 5-minute chart. For example, here, if I wanted to play this range, then I would have known to take a buy right here. If I wanted to play this range, I would have known to take a sell where? Right here at 50%. Then since that got taken out and this became an area that buyers had in control and I was playing this range, and I would have knew to take a buy right here at this 50%. And I'm on a 5-minute chart. So now you start to come into issue number one, which is something that Blue was talking to me about the other day. For those who know Blue, I think it was yesterday, and Just Rich, kind of like proteges in a way, because they understand this now. They can see almost everything. They know that the market is going to, in a way, ping pong. It's gonna buy, sell, bounce, 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 bounce. It's gonna bounce off this, bounce off that. It's gonna, so So now you start to get to a point to where it's like, damn, I can see price action so clearly to the point to where I can take more trades than I need to take. So now this is why I try to stop people from learning this, because it's like it's not necessary. Why am I gatekeeping? Why am I a course seller, which I'm not like a course seller? The course ain't even done. I'm gonna be honest with y'all. I don't even want to do it, but I'm just doing it because people, you know what I'm saying? I said I would. I didn't really want to, but I'm still doing it and I'm just taking my time with it. But it's like the reason why I'm like this is because once you learn this, it will be like you're gonna make a lot of progress just to take a lot of steps back. Because then what you'll have to learn is, okay, I have to now figure out how to filter what trade to take because I see all of them. But this is why, I have a girl who will tell me, Romel, like you can just come into the market and you can just pull a trade, like you can pull a trade out your ass, like it's nothing, like, and I do, because I find a range and I play off of it, especially if it's a decent one. I find a range and I just play off of it, you know, and then you know usually that's enough for me to make enough money that I need to make that day because I trade futures. I don't need to make that much. But if you find the range or the range that needs to be played off of for the day and for that session, then you start catching the lows of the market like this. You're using the same basic principles, but anyway, the reason why I try to like stop people from going down this road is because like once you do, you make a lot of progress and you're like, oh my gosh, this is the best thing ever. Then you get to a point to where you become overconfident and you understand the market so well that you think you can take every trade you see, and you start to lose respect for the fact that the market can do anything it wants to do, and you don't see every single detail there is to see. So at some point there's going to be something that you miss. You might see everything, like there's times where I'll sit here and I'll predict a trade, 5 for 5 or 6 for 6, like 6 trades in a row. Perfect. But then the overall market will do something that I didn't expect it to do because there was something that I didn't see, something that I missed. So I'm really good at just going in, looking for the trade that I need to take in the moment, or just waiting to see how the market is developing. And then I'm like, cool, I get in, get out, right? Not every single trade is gonna be a banger entry like this, but a lot of the trades are gonna be pretty nice impulses, enough for you to scalp or maybe hold that trade for a couple little cycles. But learning how to identify the best ranges to take these trades at, that takes it just takes some experience. It just takes some time. But anyway, so this is like, I don't know how much more I need to say. Um, I kind of showed what I was trying to show, but I'm just trying to figure out how to conclude it now. You know what I'm saying? Um, because really all of this is imbalances. Most of the focus is going to be on imbalances because that's where the highs and the lows are created of the market. They're going to stop and end in a gap in the market. I could prove that through other different ways and methods, or you could just take my word for it. If I have to pull up a volume profile chart or indicator, I can show you why that is from an order flow perspective, but that's just the truth. Okay. Now, I actually, and after explaining that, I know the next thing I want to talk about. So let me see. Um, let me read the chat. So let me see. Could you start talking about balancing the imbalances? What I mean is, how does the fair value gap become weak, or the order block gets invalidated? Sometimes it gets rejected multiple times. It fails after a single rejection because those areas also align with major supply and demand levels. I put it like this. I only trade stuff that's untested. It gives me the highest probability of success. If it's untested, then I trade it, right? Yeah. Something that's been tested multiple times, I gotta look for another reason somewhere to support why I should be buying that. Yeah, if it's been mitigated or tested already, odds are it gets crashed through. Okay? It doesn't get the respect it deserves, unfortunately, because everything deserves respect, right? If that was the case, then um, I don't think people would kill each other and people would hate each other the way they do. So the market reflects life very accurately. It's people on a chart and it's people living life. So, and people don't respect other people, nor do people respect other people's opinions. You know, people get disrespected all the time, walked over, neglected all the time, as is life, as is trading. So, I mean, like I have a little bit of a like an insensitive analogy in my head. I don't mean anything by it, but I will say it. But it's the common saying that, like, it's the double standard of how, like, oh, if men go out and hoe around, that's okay, but if a woman does it, it's all of a sudden not okay, right? So, like, it's just that perspective. For example, on a chart, um not saying that I agree with it or not, you know, so, but I'm just saying, like, uh if you have a support or something like that and it gets retested and it's common, that price level can keep getting hit over and over and over and over again. It loses its value, it loses its respect, it loses its rarity, and it gets broken, right? Only what's rare gets respected in the market. So the best prices or the strongest prices on the chart are the prices that get respected the least amount of times, or the ones that are, in this, for the sake of the analogy, the ones that are the most, what, virgin in a way, right? So let me go find some very clear examples of this, because, like, that's kind of like what that's what that's what liquidity is in a way. um just trying to find, like, something very textbook, very easy to like, we could use the same example we're looking at. So, for example, um, no, never mind. I want to see something, like, very simple. Hold on. Okay, like for example, in this sort of area, we could just call this trend line here. This trend line got hit over and over and over and over again. So these highs, or this relative area, is very common. We did a lot of trading in this area. We tap, 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 tap. It's it set itself up to get disrespected, right? Whereas now, let's look at the most strongest areas in the market. The strongest areas in the market are the areas that are tested the least amount of times, um, and they don't tend to get broken, right? So like these lows, for example, this low. What's so special about this low? For some reason, this low just got put into the market and it never got hit again. Like, why? I don't know. Right? But what we can do is now zoom in and try to figure out, all right, what is the characteristic of this low? And one of these characteristics is it happened in an area of imbalance. So now let's mark out the area of imbalance. It would go from this high all the way up to that low. It's almost like perfect, but anyway. So let's delete that. Now that I have my imbalance marked out, this from this high right here to this area, what existed here? There was nothing but buyers. So we can turn this green, call it bullish, and this is how I draw my fair value gaps. I don't have my fair value gap drawn like this, even though there's nothing inherently wrong with it. This one would be okay because it overlaps the high that was broken that confirmed the uptrend. So I would have to use some more confluences, but I just draw the whole thing, the gap in market structure, the whole area of imbalance encompassing multiple candles. When we get that, we can see how price action played out here. I don't know if I can go down to a 1 minute. I can. So now let's go down to a 1 minute chart. Price came down, immediately started making higher lows, breaking and closing above these highs inside of what? I mean, this is an area of consolidation or an area of balance inside of an area of imbalance that is just creating bullish market structure to the upside, order blocks, more areas of balance and whatnot, blah, 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 blah. Then price comes down and it dips. Where does it dip ultimately? Inside another area of imbalance in a way. Or sometimes you can just mark out the range and you can get away with understanding that price came where? Right below 50%. So then where are you buying? You're buying there. And so on and so forth. And you can build and stack your entries to the upside knowing that they're not going to get hit. You know, and boom, that's your trade for the day. Right there. Or we come all the way down, sweep some more liquidity. Whatever the case is, still we don't close below this whole range. We keep buying up. And understanding what you're looking at, you should have been able to get into buys, even from just a simple ICC perspective. Indications, corrections, continuations. And so, yeah. Let me go back to the chat so I can read what you guys are saying. Discount understood. Would you call that low a key decision level? You said this a minute ago or 2 minutes ago. I have no clue. Will I call that low a decision level? Nah. Decision levels, that's holy grail talk. Nah. An example of a decision level, actually there was one on gold. Where was it? So breaking above this high, the low that was made, or the area that was made that led to that break, is right here. That's my decision level area. That's my demand that led to the break and all of this buying. That led to more liquidity getting engineered. Point is, that's where price comes and bottoms out at news time. That was FOMC. Imagine, theoretically, you have a limit order here and you just caught the bottom of a news candle because you know the holy grail. Anyway, I was asking with relation to double liquidity that you mentioned before. Right, so that's another thing, right? That's the liquidity double sweep. That's what this is supposed to also represent too. Because when the market comes up here and it engineers some highs right here, and they're relatively equal, right? They're equal highs, or it doesn't even matter if it's just one high. The fact that it's below 50%, knowing that we need to fulfill this target in order to trigger the sell, you never take the first rejection inside of a gap in the market. You always wait for it to get rated because it's liquidity, and you need to wait for a candle to tap 50 or a candle to close above 50 and then back down, or vice versa if it was bullish scenario. Okay, so this ends up becoming raid number one, and then we take raid number two as price is coming down, and we're literally entering here before we even confirm a downtrend, just because not only can we trade basic market structure, but we understand human behavior. So we know what's going on up here. We're not oblivious, and we don't have to always wait for this. But now imagine the power of you being an ICC trader, that even if you want to wait for this entry down here and you want to go ahead and execute your trade right here and make this much money, imagine the power that you would have knowing that you can at least identify all of this and you know what's going on. Even if you're not comfortable taking the risky trade, the unconfirmed trade, you can mark out these areas, know exactly what should happen, and then imagine seeing that happen. Imagine the confidence that you have now as a participant in this, what am I trying to say? And as a participant in this market, because you already know what's going to happen when you go to the grocery store and you see something for, I don't know, like 60% off. You're going to be really trying to, you're going to be trying to buy it, right? So down here, the point, final point, what I was just trying to make, 50% off, right? You got 61.8% off. What is that? That's that Fibonacci level, right? That's that golden fib. That's that golden fib ratio. 75% off. What is that? That's pretty close to the, somewhere around that 70.2 to around, 78.6. Seems to be about somewhere in between that. 75-ish% off. You don't have to be super accurate, right? So like, point is as long as it's below and it's at these various targets, whatever the case is, 50, 60, 70, 75% off, like whatever it is, you're going to get motivated to buy. And if that's not the case, ideally, if it's 50% off in if it's let's just say like this. If it's like 40, 49% or higher off, we don't buy. Doesn't mean we sell. Because we're buyers here. So now so now let's tie this together again, right? This girl is a buyer. This boy is also a buyer. Let me look at the chat because I need to watch someone else get an aha moment real quick. All right. Both of these people are buyers. Because I didn't say that if we are, I don't know. I didn't say if we're at a 20 or I didn't say if we're at a how do you call this? Like I didn't say if we were at a premium. You know, if this is discounted, like both of these people, they're looking for something called a discount. So this discount or higher leads to a buy. If it's not that and the discount is less or whatever it is, the point is that it leads to them not buying it. Nowhere here did I say did it lead to them selling. What would lead to this person, so now for example, what would make Sally and Roger, right? What would make these two people go from being buyers to sellers? Let's see. I'm curious to see what you guys might say. What makes them go from being buyers to sellers? The answer is gonna be a percentage, or it's gonna be a number. Keep in mind, they're both buyers for a reason because the market is supposed to be bullish. We're in a bullish range. What would make them shift their sentiment to actually want to sell? Everyone's getting it wrong so far. Hold on. All right. What do you mean close below 100? Okay, 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 okay. All right, bet. Everyone who said anything about like I understood what you meant when you said zero, but everyone who said 100, like expect like this is perfect. A close below 100%, 100%, that's the correct answer. That's what's gonna motivate. That's what's gonna shift you from being bullish to bearish. If the range that you're analyzing just got taken out. That's why I do range analysis. That's why I'm drawing boxes on all these ranges, right? If my range gets taken out, then I have no buys, like I have no bullish area, no bullish percentages. I have nothing to take a sell off of. Or I mean to take a buy off of. And the sellers who just broke below my support level, the low of my bullish range, They just proved that they're capable of selling to lower prices that I'm and other people are willing to buy at. So the market conditions are starting to shift. It doesn't mean that they shifted unless we track our highs and our lows and we try to see what order that they shifted, but they're starting to shift. We're starting to shift sentiment. Because like I said, both Sally and Roger were buyers. Sally wanted to buy below 50%, and Roger was also like, yeah, I'm aligned with that. And because price is only 40% off, or it's only 10% off, I'm not willing to buy yet. So they both are buyers because they understand they're both playing off of a bullish range. Okay? They're not looking to sell. They were never looking to sell anything. Now, for those who said like if price is above 51%, you get like a C plus answer, because once again it's going to depend on what the market looks like. Okay, so in other words, let me think. So in other words, right, if the market looked like this would be a 100% retracement. This would be the 0% level, right? And somewhere in here is 50%. So we know that we want buyers to enter either at 50% or lower. And the thing is this can be here, or price could come here, or it can come all the way here. Price can even come down and manipulate with a wick, but we have a closed candle here, and this is called a stop hunt. This is called a liquidity grab. Price could come all the way below 100% with a wick, but it closes the candle and then we still buy. So how do we know that this level gets taken out? When we get a candle that closes below that area. And this is when we put weight on candle closes. We do not mark out the opens and the closes of candles as our market structure. We always mark out the wick. But when we get a candle that closes below a low of a range, aka a trend, because a trend is nothing more than a bullish range. It's a bullish trend. So this could just be like one thing, or it could be a uptrend, and that trend is a range itself, or it could be a range of a candle. Because now we're starting to draw this full circle. This concept is happening on large and small scales. On slow scales, which might take a 1 hour or 4 hour chart to analyze, or fast scales that you might see happen on a 1 minute chart, 5 minute chart, or that you would see happen from candle to candle, because every candle has highs and lows also, high time frame and low time frame. So this is happening across the board, where this could be the low of a whole ass trend. It could be the low of a couple candles that just made a range. It could be the low of a candle. Like it could, the point is just conceptually, it can happen on a lot of different scales. It would be different if the market did this. we're still inside this bullish range where this is 0% and then this is 100% retracement. Okay. But because now the market structure just printed a low and made a lower high and broke that, we just confirmed the downtrend. But we have to keep in mind it's a internal downtrend. And price has yet to break below this area that buyers have in control. Right? So it's like this. So price coming down, that's fine, because price needs to come down in order to make a higher low, which is bullish. There's nothing wrong with that. You see how we need selling in order to create something bullish? There's nothing wrong with that. But now we bought to create something bearish. And now we just made a lower high in the market. And as the price starts to come down and we break and close below that higher low, now this entire area, the buyers in the market here, they just got taken out. All these buyers are dead. These buyers are still alive. So price could, buy back up, but this starts to mark what? The beginning. And when you write this in red letters, it looks like a horror movie, because oftentimes it is, especially if we're at a major area in price action. We start to just slaughter lows, and who knows what could happen. But the reality is that buyers are still in the market until this level gets taken out, because this price could just be downtrending to ultimately turn the market around, right, in some sort of way. Who knows? So the only thing that takes buyers out the market is it's still the same thing. It's a close below 100%. But now let's just say, since we have a lower high in the market, what if price does go up? And now what range are we playing off of? This is why I said your ranges are important. We just bought because we're playing off of in a way, that's weird. Let me see. 50% of this range. And so we're buying because of, for some reason, down here, like something happened down here and that's causing price to bounce and buy. Let's just say there's a fair value gap here. Cool. But that doesn't mean like we're bullish for real, because now we still have to play off of this bearish range that we just made in the market. So now who knows what's up here that could cause price to just continue the downtrend. And depending on how much strength we have, we could just find ourselves bleeding out. So if the market had turned over, the point is like, this is where tracking your highs and your lows starts to come back into play. And I have a lot of videos about that already. But if the market started to turn over bearish, then now we could start putting weight on 51%, aka anything above 50%, as our entries for sells, because we created a valid bearish range. And what made this bearish range valid? What made it valid was because we broke a higher low in the market. We broke an area that should have led to continuation for buys. So that made this range playable. The same way how this range is playable. Why? Because we broke a high in the market. This range, like for example, like say if we were trying to analyze this bullish range, this is not valid. This analyzing this is not playable. Price, we're not going to be looking for price to come down here and do this. That's not playable. Why? Because what high did this bullish range break? It didn't break one. So it's not a valid one to analyze. So there's, I know I've taught a lot already. It's already been like an hour and 40 minutes. There's a lot of like nuances to this, but I'm just hoping to give you guys some of them right now. And hopefully, like with everything else that I've said, like that's available, you're starting to draw the inferences and the conclusions together. So anyway, let me figure out if there's anything else I want to put in this video. I think the best part was definitely going to the chart. I might start doing that more often, going back and forth from um, the chart to the screen. I mean, yeah, my drawing screen, so people can understand. Like I'm literally drawing exactly what you gotta do, but I know it's not always clicking and registering. So, do you guys have any questions? Like what gap can I fill? Pause. But like, yeah, like what gap do you have that I can fill here, just based on this today? Because we'll continue the work going forward later. Yeah, what did you say? Ah, see, that means buyers were not even interested in the sellers. That's why you mentioned defining a range. Once you define a range, you're able to see the minima and the maxima. And yeah, and trade those exactly. Yeah, I like how you worded that. I understand what you mean. But that's about it. You have to identify a range to trade first. The ranges that Sai is identifying to trade that he may not, I mean, I don't know how aware he is or not, to be honest with you. I think a lot of his perception is subconscious, you know? I'm like making what he might be seeing or already understanding over his years of trading, like I'm bringing it out so people can understand why. But it's you have to identify a bullish or bearish range in the market, somewhere where buyers were in control or sellers were in control. And then once that's broken, you just trade based off the macros of that range. You trade based off, hey, are we in a discounted area in that range? Yes, buy. And then, you can use your discretion to try to figure out how strong this range really is. If you see a bunch of BBCs, pause, a bunch of big bearish candles and big bullish candles, it's a pretty strong range, dude. You should mark it out and probably highly consider taking that trade once we tap whatever we need to tap. Hey, bro. Hey, bro. It's just an acronym. Okay. I, it, you know, it sounds better than engulfing. I don't even know what that looks like, engulfing. When I hear engulfing, I think about the Gulf of Mexico. When I hear BBCs, glizzies, shaboing boings, it does something to my soul. So that's the way I gotta think about it. It is what it is. All right. Big bullish candles, big bearish candles. If you see one, know that there's a lot of volume and a lot of demand, or just like there's a lot of money that's making that candle. All you got to do is just trade that range and do holy grail in those areas for those who know what the holy grail is. The stronger the range, the uh, the more likely the outcome. Pause. Let me drink some water. I don't know what's wrong with me. So anyway, questions, thoughts, comments, concerns? Is this a YouTube video or a WAP video? It's a YouTube video. Wick Sauce Wednesday is fair game. It is what it is. Um, right? Like y'all have to be able to watch it. Make sure you download it because you never know when I'm gonna delete it. I'm just kidding. Someone made that comment on one of my YouTube videos. It was like, hey, y'all better download this because you never know when he's gonna take a video down. I might start doing that. That might start be a norm. I might leave a video up for 3 days, take it down. I might do that. That sounds cool. It sounds you know sounds different. Ignore my glizzy comment. The question before was valid. Let me look. How do the cycles and ranges correlate? Are there a max number of average cycles within a range? Typically three. Sorry I'm late. I'm not sure if this will be uploaded or not. Yeah, typically three. I think I can put that on my list of stuff to talk about. Market cycles. I might talk a little bit about beat the market maker, market cycles, what's typical. Usually you have about three cycles in a stable trend before the trend needs to try to figure out if it's going to continue or reverse. Um, so anyway, and that's on once again large scales and small scales. So yeah, but this right here, I got some back testing to do, and I gotta talk to Rio. I gotta talk to Rio. Anyway, let me write this down. Personal notes, market cycles, market cycles. What's typical? How many beat the market maker? All right, cool. And then next week we'll get into what's the next natural progression of this? Like, okay, so right, so really we talked a lot about we talked a lot about imbalances. We didn't really talk that much about balances. We didn't talk about no trade zones. So hold on, let me write this down. We didn't talk about no trade zones, right? Which is just nothing more than consolidation areas. Consolidation. And we didn't talk about all the different ways consolidation manifests itself on a chart. So that's an order block. Um, and you have high time frame and low time frame order blocks. Okay. You have wicks. Wicks are areas of consolidation as well as areas of rejection. What they are is they are areas of consolidation at the extremes of price action, and they just so happen to happen a little fast. That's all it is. Um, wicks. So areas of consolidation. What am I trying to say? Yeah. areas of consolidation that happen at the extremes in price. And so boom, so that'll be the next natural progression of Wick Sauce Wednesday next week. We'll talk about areas of balance, and that will lead us into Wick Sauce, like what started this deviation away from ICC. It was Wix first. It was Wix first, but this is gonna be how we get into it. We'll get into Wick Sauce next week, and yeah, just other things that you just need to know. Balance. hmm Keep up to date with the YouTube channel. Stop asking me for one-on-ones and you don't watch the YouTube channel. Okay? Like, don't do that. Every video that I've been posting, like the last 6 videos, the last 6 or 7 videos, they get better and better and better because my understanding deepens, or the way that I'll teach something. Every video is a regurgitation of the same information, but there's a little different perspective or a different nuance that's gonna help somebody understand it. So, like if you've ever been to college, treat it like it's a college class. There's 2 to 3 hours a week. Okay, watch a video a week, or if you're capable of watching two a week, or something like that, one on the weekend, something like take some time that you're wasting somewhere and put it into just, even if you just watch the video and you're not diligent taking notes, that's better than anything. Watch it like it's a movie, eat some popcorn. I mean, it's not that exciting, right? But just sitting back and even just listening to it and watching it just like this, that's gonna prepare you for, that's gonna keep you up to date, because I'm not going back, you know? Like, this school year has already started. So for everyone who's like jumping in right now, you're all the way, like, we're like maybe in, we're like 40%, 50% done with how we're going about things. And then there'll be a big final exam. But that doesn't mean I can just like go back and try to pick up where you guys all left off, or go back to the beginning and try to catch you guys up. So if you're like here, you got to go back. Okay? Go back and watch the progression of how I got to this level of understanding. That's what my YouTube channel is. It's a documentary, a documentation of everything I was already doing. Like the Holy Grail, I've been on the Holy Grail for the past like 2 years. I used to call it decision levels. But now I understand it because I've internalized what it really was. At that time, it was just like, oh, I see this happens, so let me make it an entry model. I don't know why this happens, but I see it happens all the time. Then once I understood why it happens, then I was like, whoa, oh my God. It was like, you know? And that's how a lot of you guys feel like you're trading ICC. That's basic stuff, but now you're starting to be like, oh my gosh, this is crazy, you know? And that'll keep happening over and over and over. But so just keep up to date with the YouTube content, to be honest. Um, and then for those people who are VIP members, not making anything that's not already on YouTube. So, but it's just gonna be digestible and straight to the point, and I'll get it done um, at my convenience. I'm gonna be honest. So, yeah. All right, guys. Let's see if there are any more comments to read. Range imbalance plus Wix. plus Holy Grail. That's the aha moment. Cool. Off topic. Um, but when you speak highly of people's trading skills that used to be in here, like Ty and Tay, what separated them? Um, Nothing separated them. Me and Ty are still very connected. Ty, like I talk to him on the side, but Ty is just more of a private person. He's a private figure. He's not customer facing or public facing at all. And Tay is doing her own thing. And then is the Holy Grail on YouTube or paid? Deliberate Holy Grail content is on my walk. It's not on YouTube, but I do drop nuggets here and there. For people who sit down and watch the whole video through, there will be a random moment at like an hour and 27 minutes in where I cover the Holy Grail, or it might be 2 hours in. So if you're skipping through it or not watching it all the way through, you're not super diligent, then you won't see it, but it's still gonna be out there. Okay? Like I kind of know and get the gist of who watches my videos and who doesn't, because you see all these DMs, people will just DM me and be like, "Yo," you know what I'm saying? Be like, "That's crazy." Um, I've been using my 34-hour resets to watch and study. What do you mean 34-hour resets? I can see now the connection of the decision levels to the Holy Grail answered your question a lot. Cool. Exactly. They're Easter eggs. You gotta leave an Easter egg, you know? Well, you don't have to leave an Easter egg, but I just want to leave an Easter egg. Oh, 34-hour resets. Oh, I get you. All right, Eric. I got you. Got you. Your time off. What's the best way to do it? Alrighty. All right. So if that's all, this video is an hour and 57 minutes. Um, I'm gonna end the recording, start uploading it to YouTube, and I have another video I was gonna post already. Um, I think I'll just post this one. I think this is the one that I want to post for real. So I don't know. I'll think about it, but it's gonna be posted by the end of the week, or it's either gonna be posted like tomorrow morning, tomorrow, or on the weekend. But y'all see it. All right. So without further ado, um, deuces.